Hello guys, today we're going to see AS1 disclosure of accounting policy. First, accounting policies are a methods, principles which is adopted by the enterprises in preparing the financial statements, in preparing the accounts. The companies is adopting some method. That method is called the accounting policy of that enterprises. Say there's a company called X Limited, and that company is adopting a method of straight line method of depreciation, and it is adopting a method of deferred government grant method, and they are using a cost model for valuing the assets. And these are the methods which is adopted by the enterprises of the X Limited, and these things will become the accounting policy of X Limited. There is a company, another company called Y Limited. They are following different methods, and that methods becomes the accounting policy of Y Limited. So this is accounting policy. When different companies is following a different methods of accounting policy, it is not possible for a shareholder, stakeholder to compare the two companies' financial statements. uh, Even though the underlying transaction is same, but because of using the different accounting policy, the information which is reported in the financial statement is different. So there is a lack of comparability of financial statements between the different enterprises and same enterprises. If a company is changing the accounting policy from 1 year to another year, it is not possible to compare our own company's performance with previous years. So the it has to be to disclose the policy which is followed by the company to the stakeholders, to making the decision based into consideration of disclosure of accounting, into consideration of accounting policy into consideration while making an economic decisions. And as per Indian accounting standards AS1, uh, disclosure of accounting policy is essential in case of a fundamental accounting assumption is deviated. What are the fundamental accounting assumptions? First is going concern. A company is not having a intention, and there is no compulsion for a company to materially curtail the scale of operation. A company is not wind up in the future, it is continuing its operation. There is not any, let's take for example of, we don't have any intention to close the company, but there is a case which is going on outside, which going to end the company's life, which going to make the companies liquidated. And in such case, the company's accounts are not prepared on going concern basis, they are prepared on liquidation basis and NRV basis, net realizable value basis. And whenever the going concern assumption is not followed, it has to be disclosed in the financial statements in disclosure of notes to accounts. And uh, and second fundamental accounting assumption is accrual. Accrual is a recording of the income as and when it is earned, irrespective of the amount is received, and expenses are recognized as and when they are incurred, irrespective of when it is paid or not. When it is paid, it's not a matter of recognition. Accrual method should be followed even as per Companies Act. So whenever a company is not following fundamental accounting assumption of accrual, it has to be disclosed in the notes to accounts. And third accounting assumption is consistency. Whenever a company adopts an accounting policy, it should be applied consistently over a period of time. It should not be changed year to year. Let's say first year the company is following straight line method, the second year they're following WDV method. It should not be done. The accounting policy can be changed only because of three reasons. One, there is a change in statute. Two, there is a change in accounting standards. And three, for better presentation of financial statements, a company can go for a change in accounting policy. Whenever a company is going for change in accounting policy, the effect should be applied prospectively. It should not be applied retrospectively. It should be applied prospectively. Sorry, it should be applied retrospectively. And change in accounting estimate. Accounting estimates are the judgments the management is making based on the circumstances. And accounting estimates are made for many items in the financial statements cannot be found with precision. Let's say the life of this asset is not this year, it is not an accurate measure, it is an estimate based on the available information. We can estimate the accounting estimate. That's why it is called accounting estimate, and these estimates can be changed year to year. Um, there is a the effect of accounting estimate should be given prospectively. It should not be given retrospectively like accounting change in accounting policy. Whenever there is a change in accounting policy as well as change in accounting estimates, and it is a material impact on the financial statements and the profits of the intercompany, it should be disclosed. Even there is a possibility that it does not impact on current year, it is also impact on the future year profits, then it has to be disclosed in the notes to accounts. And the general disclosure of this standard is tells that what method you are following for depreciation, what the assets are valued, cost model or revaluation model, how the government grants are treated, either it is reduced from the cost of an asset, or it is treated as a deferred revenue expenditure and kept in a deferred revenue side of liability, and revenue depreciated based on the proportion of depreciations. And the inventories are valued at cost, inventories are valued at weighted average method or FIFO method or LIFO method or units of production method, whatever the method which is followed, that should be disclosed in the notes to accounts. And these things is still by this standard AS1. That's all.